We have with us today Dr. Venkatesh Panchapagesan, Professor of Finance and Head of Real Estate Research Initiative at the IIM Bangalore. He got recently promoted as a professor. He was earlier an associate professor. And congratulations to you, Professor Venki.
Thank you.
Yeah. He has more than 25 years experience in academia and in the global financial services industry after finishing his PhD in finance from the University of Southern California. Prior to joining IIMB in September 2011, he was with the world's largest hedge fund, Bridgewater Associates, where he led efforts to revamp trading analytical infrastructure. He also worked with Goldman Sachs Asset Management in New York between 2005 and 2008, overseeing trading research for their quantitative hedge funds. Before joining Wall Street, he was a finance professor at the Olin School of Business at Washington University in St. Louis from 1998 to 2005. And he has published in top peer-reviewed global academic and practitioner journals. He was also invited to the NASDAQ stock market as a visiting economist between 2002 and 2003. He is certified in India as a chartered accountant and a cost accountant and holds a postgraduate management degree from IIM Calcutta as well. Aside from his academic responsibilities, he is also an independent director and consults for a few Indian companies. He has been a member of several government committees and was a member of the governing council of CAFROL, RBI's research think tank between 2017 and 20. He was India's sole academic representative on the advisory committee for World Economic Forum's initiative on real estate in 2015 and 16. Today, he is going to brief us on the emerging opportunities and challenges in Indian real estate. Over to you, Professor Venki.
Thank you, Arun, and thank you, Vineet. Thank you, Charlotte, and also welcome to all of you. I know the time zones are all mixed up. So generally, good morning, good afternoon, good evening to all of you. So I'm going to talk about Indian real estate, and since the audience is quite diverse, I just thought I'm going to start by asking you a question. So what you need to do is you have to go to this website. I'm hoping that you guys have access to an internet, either through mobile or through a computer. If you go to menti.com, and as soon as you type menti.com, there would be a box which shows you the code. You just need to put in the code that is given out here, which is 13458971. If you type in the code, there would be 3 boxes that will open up, and you can just put in whatever comes to your mind. And the idea here is I'm trying to create a word cloud based on what you know or what you think about the Indian real estate. So can we just take a minute to do this so that we can get a good sense of what you guys think about the real estate in India?
Friends, please check out the chat box. You have a URL link. You can use that to go to the website and input the code as mentioned in the chat box and provide your feedback for us to get an idea about your perspective on real estate. We'll wait for a minute or two.
Yeah. No, as and when people put in, I think the cloud should start filling up.
Okay.
Real.
And there are 3 3 lines to be filled up. So it can be just a word for each line and then submit. Press submit.
So I've got only 4 responses so far. I think need more to make this really a... It's interesting that everybody is talking about different things. Because the way the word cloud works is as more and more people repeat the same thing, it sort of grows in size.
Okay.
So right now, all the words look alike. So it seems like everybody has got different issues with the real estate.
And friends, it's all anonymous, so there's no personal data.
Absolutely.
Or even there is no direct any information pertaining to the person who is giving this.
Yeah. Whatever happens in this form, in the Zoom call, stays in the Zoom call, so it doesn't go out. So. Right, quite a variety of explain. Maybe another minute before we close it. I think the 2 things that stand out, at least at this point in time, is risky and opportunity. The rest of them sort of. Yeah. All right.
Yeah.
Okay. All right. Thank you. So I think thank you for giving me an insight into your thought process. I think from the kind of responses that I see, it looks like a lot of people are reasonably familiar with the Indian real estate, because somebody even mentioned RERA certificate and so on. So that's like a third level of detail that I was not expecting from this forum. But that's great, I think, because then we can sort of change the talk depending on what would be most useful to you. So anyway, thank you again. I'm going to move to the next slide in terms of just so the way I thought about it, right? I mean, given that I was not sure what the audience is going to be, so I thought, let me frame this as the good, the bad, and the ugly. And so that's why you saw the Clint Eastwood poster on the front page on the first slide. So the idea is that there is a lot of good things about the Indian real estate, both in terms of its current state and also its potential. And then there are some bad things. And of course, some of these bad things are structural. So which means getting rid of them is not easy. It'll take time, but it's doable. And then there is one thing which is really ugly. And then the reason I bring that out is it's not easy to get rid of it, because that requires a fundamental mind shift in the nation's psyche, and I think that's something which is, in my mind, a very critical hurdle to the growth of this sector, or at least, in terms of what you see relative to the other countries like China and the US. So in terms of the potential, right? So, I mean, I think a lot of you know that India is in this growth spurt, especially given that the rate of urbanization is probably at some of its highest rate ever. And I mean, in fact, one of a recent study by the World, I think UN Habitat study, it talked about something like 13 to 15% increase in urban population. So it's largely a combination of new people born in the cities versus migration from the rural part of the country to the urban clusters. So in 15 years, you're going to see something like a 15% increase, which roughly translates to about 190 million people moving into the cities, into the urban clusters. So just to put that in a context, you're talking about 3 United Kingdoms or 5 Californias,
Oh.
So we need to house 5 Californias or 3 United Kingdoms, or maybe, 10 Texas or something like that in a span of 15 years. So that's think of it like a challenge, but also think of it as a potential that we, if at all we do this right, this could really be a game changer both to the economy and to the sector. So that's the first thing to keep in mind, that there is this huge macro shift that is happening, which we don't have a way to stop it, but it is going to create a huge real estate impact. So if you translate that in terms of housing shortage, and I'm talking purely based on shortage driven by this urbanization shift, we are talking about 60 million new houses that needs to be built. And even with, a lot of conservative way of looking at this, you can think of this as something like 90% of them could be in the smallest house category, which is what the government defines as 600 to 650 square feet home. And then using some reasonable floor space index that we call, which is how much land you need and so on, we are talking an infusion of about $640 billion plus in terms of capital need. And I'll get to the land need in a short while. But basically, there is this huge need for capital that the industry has to get in order to meet this urbanization. And you all know what happens if you don't meet that need, right? There is going to be a proliferation of slums and proliferation of substandard homes, which eventually affects the productivity of workers and so on. So there's a lot of study and research on the impact of substandard housing on GDP and so on. So practically, in my mind, this is sort of a no-brainer for the government to seriously consider stepping up its game in order to meet this shortage. Aside of this, we also have to rehabilitate existing houses. In fact, census is one large study which looks at housing. When they ask questions to people, they also provide some indication of what type of housing do people live in and what conditions that house is in. And if you take the general, assumption of how many houses need structural improvements and so on, we are talking another $40 to $45 billion in terms of rehabilitation of existing houses. So which means if these houses are not rehabilitated, either they will have to be completely taken down and rebuilt, which means it will be the cost will be double or triple of this in terms of redoing this. So here the land cost doesn't exist, but there is an additional cost in terms of redevelopment. And aside of this macro, there is one cultural factor that seems to be driving the Indian consumer, which is, for some reason, we prefer real estate and gold. And in fact, that the basis for this preference itself is like a single topic. We can talk about it for an hour or more on what drives this cultural thing. It could be a range of lack of social security. It's a perfect intergenerational sort of investment that you can pass on. Relatively lower transactions cost because liquidity is reasonably high, and the lack of trust. I think somebody mentioned in the thing on lack of trust. If you consider the financial markets today, today people are a lot more trustworthy, at least in some core urban centers. But if you ask an average Indian in the rural part of the country, they would say that they would rather hold it in gold or real estate compared to putting it into stock market where the money can vanish tomorrow. So the volatility in the stock markets kind of deters a lot of people from coming in. even though over a long period of time, the markets give you a much better return than some of these physical assets. In fact, recently RBI came up with a report, RBI being the Reserve Bank of India, the central bank of the country, and they actually found very interestingly that the Indians' holding of these physical assets have actually gone up compared to financial assets, which sort of bypass. I mean, it goes against the trend in the last few years. So again, why we are not asking that question, but in general, this is a cultural preference. So in terms of investment in real estate, people do consider this as a lot more safer for various reasons. So this is on the residential side. If you look at the commercial side, I mean, when I talk about commercial real estate market, we are talking about a variety of different types, ranging from office market to retail, which is the shopping malls and literally the strip mall kind of markets, hospitality, the hotels, warehousing, which has come out recently, data centers. So these, all of them are broadly brushed under this one large umbrella called commercial real estate. And if you look at what drives the commercial real estate, there are two major factors driving it. One is the local demand, which means this is a demand by Indian consumers, Indian corporates, a variety of people who need office space or warehousing space and so on. So there are a bunch of triggers why the local demand for commercial real estate is very robust. One is, of course, the larger India growth story. I mean, as of today, very few countries are able to generate 6 to 7% year-on-year GDP growth, even though there's a lot of debate on how to measure GDP. In general, we do feel that the nominal GDP rate at least is growing at a very healthy 6 to 7%. And the expectation, at least from many of the economists, is that it will last for another decade at least before it plateaus down, because there's so much need or capacity that needs to be hit before the GDP can plateau down. So what does that mean? It means that the growth story translates to so many new companies coming in or existing companies growing in scale. And their demand for office space is what is going to drive the next wave of the commercial office demand or real estate demand. So, of course, we also know that India is now becoming one of the hottest startup markets. I think we grew from 445 registered startups to something like 86,000, which is a phenomenal 140% annual growth rate. And today we have 100 plus unicorns, even though some of them may be fast hurtling towards a non-unicorn status. But in general, what you're seeing is that many of these startups are in the service-oriented space. Like for example, the Swiggies of the world or Zomatos of the world and so on. So these are creating new demand for housing. So which means what has happened is that there is a layer of population which previously were staying with their parents, or they did not have an independent real estate demand, and so now that is growing, and it not only is going to propel the residential demand, but it is also going to make some of these startups need office spaces, especially where there is a lot of high touch needed for those companies. Similarly, India is also in a very unique space in terms of the digital consumption. And the reason why this makes a big difference to the real estate market is that one is, of course, the India stack, as you know, which is largely the digital public infrastructure, or DPI as they call it now. It is creating new business opportunities. So it is essentially feeding into that first point of the 6 to 7% GDP. So many of the companies are growing faster because of the technology that is getting embedded into their business model. And aside of that, there is also because so much technology is now being embedded, there is also a huge amount of data that's being created. So a lot of need for data centers and large warehouses for data. And I think that itself, for example, translates to 15 to 20% in the last 5 years in terms of the introduction of data centers in our country. In fact, some of the interestingly located cities which are in the cusp of transportation hubs, they seem to be extremely popular for data centers because they are low. I mean, the land cost is low, and at the same time, they are very nicely plugged into the transportation network. So that, if people need to have electricity and so on, so the power grid is very critical for data centers and so on. So it becomes a very interesting new market development that's happening in the country. Of course, e-commerce, I did mention a little bit. So e-commerce has also translated, has been growing at a breakneck speed of 20 to 25%. So e-commerce needs a lot of warehousing, for example. In fact, many of these markets are now moving to a hyper-local sort of distribution network. So essentially what it means is that the warehousing is now staged in multiple levels. There is this giant warehouse, then there are mid-sized warehouses, and then there are these really hyper-local small sort of shops which act like warehouses for local markets. So there is a multiple innovative sort of ideas that are flowing through e-commerce in general, because as you know, e-commerce is one business where the margins are very tight. So therefore, the ability of real estate to meet, to ensure that the margins don't go out of whack is extremely critical for the e-commerce itself to survive. And so then, and the last part of it is on the domestic tourism. I mean, we already know that the foreign tourism post-COVID has come back. But the interesting part in India is that the domestic tourism has been growing at the rate of 8 to 10%. And I think that has also opened up new sort of ideas for hotels, sharing bed and breakfast kind of joints. So there's a multiple level of real estate development that's happening in the hospitality side. So this is generally to show you that the potential for the next at least a decade is robust, and it is based on a very strong foundation of all of these factors. And because most of these are not reversible, in my view, it has already gone through. The second part of the demand is coming from foreign companies and foreign institutions which need Indian commercial space. And I think there, of course, we all know about the offshoring attraction because of the huge talent pool that we have in this country. And then now with this new tech ecosystem, which is the India stack, and the fact that, a lot of it is digital now, it has created what is called the Global Capability Centers, or GCCs, as they call it. So essentially, these are, think of it as a very niche sort of a business or a reason for which a foreign company looks at India as a potential place. So I'll give you an example. In Bangalore, you have Mercedes, which has the largest the largest innovation lab for them, hub for them outside Germany. It's in India. And the same thing with Jaguar, and there is a whole lot of companies which are now looking to set up their R&D hubs in India. And for them, they need quite a different type of real estate. For example, with Mercedes, they need a particular type of commercial office spaces that suits the innovation environment which they have in Germany. And of course, most of you might have read about the iPhones, the iPhone manufacturers coming to India, and the same thing with chip manufacturers, with NVIDIA and so on. So these are all niche sort of need, as opposed to the generic service-based offshoring that used to happen in the previous real estate cycle. So this is a very interesting and very exciting opportunity for the real estate industry, because if you cater to one large player, you're going to very soon attract a whole lot of other players in the same field, which is what has happened in the automotive R&D. So when Mercedes came first, and then now we have all sorts of foreign players coming into the country in a big way. And the reason being that, as you know, innovation happens in clusters. Like the Silicon Valley is a classic example, right? So because people need to talk to each other, there should be an easy transferable labor pool and so on. And I think by getting a lot of those niche industries or niche companies to come to India, we could actually completely change the game in terms of how foreigners look at the Indian real estate, as opposed to the standard large companies doing service-based offshoring. And then there's another angle to the foreign demand, which is our China plus one strategy. As you know, many companies are de-risking from China, especially on the supply chain side, including Apple. And so one of the things that has happened is that there is a whole lot of supply chain based setup that is driving some of the demand coming because of the strategy. And again, this is sort of leading to some of the GCCs that I mentioned earlier, but this is completely driven by trying to de-risk from China. It's not that India has any special unique advantage. It is just that they're coming to India more as a way to mitigate some of their risks that they face with China. So this is largely what the demand drivers are for the next decade for commercial office spaces. And just one small comment here. Please stop me and ask questions in the middle. I'm a professor in a business school. I'm used to having me interrupted all the time. So please don't hesitate to ask me questions or raise your hand if you have anything. Okay. So in terms of sizing the market, again, I'm putting some rough numbers because some of these are very difficult to prove. These have a lot of assumptions behind them. So what I'm doing is I'm classifying the real estate market in two ways. One is the market size from a flow-based perspective. Flow-based meaning how much activity that is happening in the real estate industry at a point in time. So this looks like, things like investments, construction activity, development, all those things can be put under this bucket. So in a way, this is the kind of a number that you can use to compare it with what is the percentage of GDP. Because when typically people talk about, roughly real estate is X percentage of GDP and so on, that's what they mean. So they mean by looking at the activity which is causing all these real estate related activity. So roughly, if you go by that, we are about $650 billion by 2025 to grow to 1,000 or $1 trillion by 2030. Just to benchmark how big we are relative to the two large real estate markets, in the same like-to-like comparison, China is about 18 times bigger than us. And US is about 8 times bigger than us. So there is a lot of headroom for us to catch. But clearly, China is way ahead of this game in terms of, at least I would say, about 10 to 12 years ahead in terms of both the structural changes as well as the market-based changes. Arun, you had a question? I thought I saw you raise a hand.
Yeah. If you will permit me,
Sure.
More than a question, it is kind of crossed my mind. Do you have any statistics with respect to the capitalization of the real estate sector, where it would be an optimum in terms of in relation to the GDP of the country? Where it is over, you can consider it as overbuilt kind of scenario, So is there any measure where we realize that, it is overbuilt and then you kind of slow down for a macro level planning is one thought that came to my mind. Second is on the growth opportunities you had expressed. There is the urbanization process, though I believe that it is kind of an irreversible factor which has been happening across the globe. Post-COVID or during COVID, we moved away from the core cities into the suburbs, and then work from home had an impact. And now we are trying to resurrect. We are trying to resurrect the old, and then asking people to return to work. So, do you believe that there will be a disaggregation because of WFH? These are two questions I have in mind. Sorry.
Actually, great questions, Arun. Great questions. Thanks for asking this. Let me address it quickly on this. I think I do talk about a little bit later, but to address your question right now. So there is this, I don't know whether there is any optimal percentage of GDP that real estate should consume. But if you look at the two markets, US, which is sort of mature, which has reached the thing, and China, which is rapidly getting to that stage. Now, probably they are in the oversupplied range, right? So the real estate as a percentage of GDP in the US is roughly about 12 to 13%. And that number has been largely steady for a decade. Okay. So I would say a steady state sort of, because this real estate includes new development, new construction, and rebuilding of the old one, right? Replenishing of the earlier structures. So I think in general, 12 and 12.5% is the steady state. But if you look at China, the other where the oversupply has happened, China today has about 30% of GDP. So I would assume that 30% is far high, maybe 30% was needed for a few years in order to reach that supply, because we know, as you see, right, the shortage is phenomenally high in India. But in order to reach that stage, we may have to do 25 to 30% of GDP at some point in time. But given our structure, unlike in China, where you could force that sort of percentage on the economy, in India, it has to naturally, organically evolve. And I doubt it will ever reach beyond 15%, or maybe, because just too many other hurdles that makes it hard for real estate investment to be that high. So my guess is that we will keep ambling towards that number, but slowly. So that's the first answer. On the terms of post-COVID work from home, I think the interesting thing that has happened is in India, people did move to wherever the local places. But what's happened universally, not just in India, universally, is that it can't be 100% work from home. It has to be 3 days, maybe 4 days, depending on the negotiation you have with the company, right? So imagine you're a 4-day work from home model, which means you can't go to Assam and come back for that 1 day. Come back for 4 days, so which means you have to live close by. So that whole movement in the US, it's possible because people's suburbs are still within transportation reach. You could still maybe at most 1 or 2 hours, right? So if I have to come in days a week, I can take the effort to come in. Like I remember a couple of people when I was visiting in New York, they were living in upstate New York, and they used to come to the city 2 days a week. And so when they come into the city, they used to stay in a sort of in a co-living space, and then they leave. So those sorts of models came up, and in US it's possible. In China is also probably possible because of high-speed trains and so on. But in India, it's impossible. So you have to live in the city if you have to work there. So I think universally, or at least in India, I know for sure that this living in your hometown and coming back means you have to quit your job. So unless you're in a creative space where your company is okay with it, or you're in your self-employed mode, So anybody working in a company will have to come back. Okay.
Got it.
So if I move to the next thing, which is on the stock level. So I'm now talking about real estate market size in terms of all the construction that has happened already up till this point, right?
Oh.
And then take a valuation of that. Again, these are all sort of an average estimates. So what you see here is India is the orange the bar is India, and it's sort of wedged between these two large markets, China and the US. And so this is, and again, compared to the last chart, which was all in $1 billion, we are talking about $1 trillion here. So, I mean, obviously we're talking about stock, and here China is about 3.5 times and US is about 3 times where we are. So which means we do have a lot of stock. So what I was trying to get at is there is a lot of stock of housing or real estate in India. But my guess is a lot of it is substandard or probably, ready to fall off, I mean, so you need, in order to even bring them up to current standards, whether it is in terms of, electricity, space, or sustainability,
amenities.
we're going to talk about. So all those things, right? So clearly there is a lot of opportunity. I mean, one is to think of it as a big problem, but I think of it as an opportunity if the government gets it right. I mean, this could be a phenomenal game changer for the economy. Okay. So coming to other parts of the good. So just I want to mention a little bit about the macro conditions that we have right now, and also at least in the next few years. One is on the fiscal spending. I don't know whether people are aware of this, but in India, at least if you look at the last 3-4 years of GDP growth, a big chunk of it comes from the government spending. I mean, it's not coming from private investment. I mean, the private investment is still pretty low. So a lot of the energy or the engine for the economy is coming from governments pushing it. And I would assume this is going to continue for some more time, at least with this administration. Because unlike, this administration still is focused on building the infra and so on. So we already have metros, highways, there are smart city build-outs. So all of these at various things, I'm not saying each one is significantly large, but all of them contribute towards the development of the foundation on which the real estate is resting. So which means a better infrastructure would bring in more need for housing, more need for commercial spaces and so on. And because of which the valuation will also change. And so, for example, with metros, we clearly see, right, with the houses close to metros command at least 8 to 10% premium compared to houses far away from a transport hub. So these are things that will help the market to grow. And of course, now we are coming into an election year. So I'm assuming a lot of election year based spending in the infra will happen. And I think already the government have started announcing a few things. So these are all things which are good news for the real estate sector, on the construction sector. In terms of policies specifically, some of them have been long drawn policies. On the demand side, we have had quite a bit of subsidies given to home loans, especially for certain sized loans. So, which means that basically if somebody is buying a house and they are taking a mortgage, what you're going to see is that the government straight away subsidizes the interest. So now, in other words, literally, your interest payment is reduced to that extent. And so that has been a big help to at least certain kinds of consumers in the market. Of course, we have also given a priority sector tag for affordable housing loans, which means essentially banks can now lend at a much lower rate because they are considered priority sector lending. So these, again, I would not think of each one of them have been a big game changer on their own, but they all contribute to keeping the demand robust, at least at the mid-level to the bottom level market. On the supply side, which I think between demand and supply, I would assume that supply is weaker in the sense that we don't have enough incentives on the supply side to make the real investment that private investment that you're expecting. So on the supply side policy, we have the foreign direct investment. For example, now foreigners can invest directly in real estate projects. Different types of constraints have been removed. And there are multiple channels by which foreigners are coming into the real estate sector. We'll talk a little bit at a later period. There are tax incentives to developers, especially if they have to build affordable housing, which means they don't have to pay income tax, they don't have to pay GST. I mean, there's so many variety of taxes that are taken off the table if the developer wants to invest in affordable housing. The third is tradable development rights. So the development rights is essentially the state governments. I mean, this is usually the state governments. What they do is they provide incentives for developers to build or allocate some part of their land for low-income housing. And in return, they will get development rights in some other place. So in concept or in theory, this is a fantastic idea because you're allowing markets to work, because each of these rights can be tradable. So which means somebody developer doesn't want to use it, they can actually go and sell it to another developer. So that whole concept was well thought out. But unfortunately, the execution in India, like everything else, has not been great. So this TDRs are still sort of crippled because of some of the policies of the government. Then, of course, we now have a very specific distressed fund for investing in developments that are where the developer is financially constrained, so that they don't have money to continue the development. And so most of these projects have gotten stalled. So now the government is trying to push them out of the way by bringing in both their own capital a little bit and also some private capital to come in. It's a very small fund. I mean, in terms of context of how big the market is, but it is a good, at least a start. And I think if it goes well, maybe there is a clear reason why we should fund this more in the subsequent budgets. So this is on the supply side. On the regulation, as you all know, there are two major regulations that have, I would say, really are a game changer for the industry. One is the RERA, which is the Real Estate Regulatory Authority Act. And this is to do with more of cleaning the sector of some bad practices. I mean, it's not changing the way people are building, or it is not bringing in new technology. It is not doing anything. All it did was it eliminated some of the bad practices, which kind of was the reason behind the trust deficit that somebody was mentioning earlier on. So this is a real game changer in terms of how it has kind of brought the developers online. We are actually working with RERA. So I have some very first-hand view of how RERA is working. My only concern is that this is another place where we have got the right intention, and it is very close to being completely captured by the vested interest. So you have slowly some bad practices are creeping into the RERA functioning itself. In fact, the worst I've heard is that RERA has now become another sort of place where people have to pay money to get their project registered.
Oh my God.
So things like that, which I think in my mind, if the government is serious, they need to really push hard on making sure that that doesn't happen. Because once people lose trust in RERA itself, then you'll have a problem. Because I think this is supposed to be one of the best things that have happened to the real estate industry. On the other side, for the developers or investors who have gotten, or the homeowners who have gotten stuck in projects, you have the insolvency and bankruptcy code that has sort of helped in ensuring that there is a reasonably quick resolution of these sort of distress situations. Here too, where we started with IBC in the 2017-18 time period to where we are, a lot of changes have happened vis-a-vis the real estate sector. The recent one, which I thought was very interesting, is having previously, when a company goes bust, I mean, the whole IBC is about bankruptcy of the entity. So which means if a builder is bankrupt, he's bankrupt, period, right? Even though he may have 100 projects where 95 of them might be doing well and only 5 are distressed. But I think the latest amendment to the IBC that has been proposed is to say that we should not consider the builder as one large entity. We should consider the project as the entity. So which means a builder can technically go bankrupt for 5 projects and continue to operate the other 95 without trouble. So this has positives and negatives. There are lots of things that can go wrong with this model, but at least it shows that, they want to resolve this problem, because otherwise what happens is that some good apples are thrown along with the bad, so they wanted to prevent that. So this is on the regulation. So I think I would say today our regulatory clarity for the real estate industry is a lot clearer. I mean, it's a lot higher than what it was 10 years back. So the developer knows what kind of regulations they have to deal with. I mean, still it takes time, but at least, the concept of what they need to do at what points in time is much clearer now than before. On the industry, of course, the industry has now been phenomenally a producer of data. So, I mean, about 20 years back or 15 years back, it'd be hard to find out what's going on in the industry unless you talk to the people on the ground. Today, you have a large number of data vendors who provide you information on your desktop on how many projects are launched, who is building what, which city has absorptions. I mean, all sorts of information related to the real estate, both the residential and the commercial spaces are now available in plenty, at least in the major cities. And I think this is a phenomenal positive thing for the sector. In fact, because of the data availability, people like me who are doing research can now actually dig into the data and start looking at things. And that's what we are doing so far. The other thing that has happened in the industry, which is a good thing, is the consolidation and the formalization of developers. So consolidation meaning that if you take the number of developers who are out there who are building new projects, that has shrunk. And so what's happened is that people who are doing 1 or 2 developments before, who call themselves a real estate developer, they are finding it very hard in this high compliance cost regimes, because they have to go through RERA, they have to keep a lot of things, they are obligated for 5 years post handover and so on. So there is a lot of compliance cost that is imposed upon developers who are in this business. And by nature, smaller guys are finding it very hard. So many of them are leaving the industry. And therefore, what you're seeing is the larger players are getting a bigger share of the market. The other thing is the formalization itself. So developers who are just sort of, literally 2 guys in a garage type of model, they are slowly moving into an organized thing, because you need to keep data, you need to file reports with RERA, you need to follow up, you need to handle consumers' complaints in the social media. So all these things, especially in the urban centers, is forcing developers to create formal entities where, it's like a regular corporate housing. So it's no longer 2 people just figure out a land parcel, get somebody to construct and move on, but sell it and move on. So I think that formalization and consolidation in the long run is the good thing for the industry, because then you can start thinking about scaling, and which is really what we need. Similar to this, we also have this corporatization and institutionalization of capital. So what I mean by corporatization is that now today we have 4 or 5 large companies like Tatas and Birlas and Mahindras and Godrej, companies which are generally well-diversified conglomerates who have a real estate company, who have a real estate development company. So which means the kind of brand that they bring in, the clean brand that they value that they bring in is helping the industry in a big way in reducing some of the trust deficit that exists in the sector. Similarly, the institutional capital, previously it used to be banks or NBFCs, the non-banking finance companies. Today, you have large private equity funds, pension funds, institutional shareholders, mutual funds. So many of these people are coming in a way to fund it. And of course, they all have very high governance requirements. And that's also helping the industry clean up some of its practices. Because, for example, if Blackstone needs to buy into a property, they need certain governance requirements. And so therefore, developers have no choice if they have to reach out to this capital, which is bigger and also probably cheaper than what they would get otherwise. There are interesting business models that have developed, which is one is a platform funding model. So now people no longer have to do the project-to-project funding. They can just do a platform. And that gives a lot more flexibility to developers. Similarly, huge amount of adoption of prop tech. And so it in a way, I think I would say a lot of good things that have happened in the last decade, which will help the industry take on the scale in a positive way. So that because we know the shortage is so high that people have to scale in order to reach that shortage. So even, for example, from 12% GDP to 15% GDP, a 3% increase is a phenomenal amount of activity that needs to be happening. And for that, you need scale capabilities. And some of this is going to bring that. And I'm going to talk a little bit about investors. I'm assuming a lot of you might be interested in real estate as an investment option. So I just wanted to say that today, an investor, whether it's a corporate investor or an individual investor, has a variety of options to play the real estate game in India. And I wanted to start with the more structured investment vehicles to our unstructured investment vehicles. So the first one, of course, is there are a lot of real estate stocks which are listed in the Indian stock exchanges, and along with the derivatives, they're available for you to buy and sell. So, for example, the BSE Realty Index is about 10 companies, 10 large real estate companies across the country. So you can easily invest in each one of them. Unfortunately, there is no exchange-traded fund on the Realty Index, but it's just going to happen in a few years. That's going to be the next logical step for this. So the investment directly in stocks is one good thing. The second option available to you is through the REITs. While the first one, which is investing directly in the stocks, is investing in the entity level. So which means you are investing at everything that the company owns. Here you're investing in projects or investing in certain land parcels. So usually REITs, because a real estate investment trust, require a steady stream of rental income. So they are largely rental income producing properties. And in India, the residential part does not produce the rental income on a scale. So which means the entire REITs in India is dominated by commercial REITs. So it's either office REITs or retail REITs and so on. So it's not like in the West, where there are a lot of residential, social rental, housing rental REITs which are available. But unfortunately in REITs, we have 3 REITs, large REITs, which are listed in India. The first one being Embassy REIT, which was in 2019. If you look at a REIT structure, they give you returns in 2 ways. One is they give you return as dividends. So because the REITs, by definition, very much like Indian mutual funds, they are pass-through entities. So that means they cannot keep the rental income to themselves. They have to pass it directly back to the investors. And that's the reason why they don't have to pay tax. So you pay tax as an investor. So the REIT, so you get the dividend income, which is going to be a reasonably high dividend yield, which I think in the case of Embassy is about 7.5%. The other kind of return you will get is on the capital appreciation. So which is when the property gets sold or churned, you do get the capital appreciation as well. So if I take a total return for Embassy REIT, it comes to around roughly 5.5% over these 4 to 5 year period. The same time period, and I only looked at 2019-23 because 2019 is when the first REIT, Embassy REIT, was listed. So Nifty was 16.5% in total return terms, roughly. And GSECs, which are government yields with zero risk, is 6.5%. So as you can see, right, I mean, in the US, REITs come in the middle between stocks and bonds. They are slightly above bonds, but less than stocks, because they are slightly more risky than government securities, but not as risky as equity. So that's the logic why they fall in the middle. But in India, for some reason, we have not really got well. And this worries me because Embassy REIT has a couple of good things going for it, right? One is because it was a first REIT and it had really good properties. And the vacancy rates are low. So practically you're talking about the best possible combination of properties that you can list. So they themselves are not going very high. And in my view, it's probably not because of the REIT structure, it's because of Nifty and GSECs being too high. In India, equity is like a casino, so 16.5% is like huge. I mean, so a lot of money is going into few stocks in India. And so whenever there is this huge capital infusion coming in from the rest of the world, I mean, the stock market just takes off. So it's very hard to imitate or mimic the Indian stock performance. And also in the government, because I told you, right, the last few years, the GDP was run by fiscal spending. And where does the government get money? So the only way government can borrow money is to borrow at high rates. And so the GSECs are also very high. So I think for a variety of combinations, our Indian stock and bond markets are screwed up. And because of which the REIT is paying the price. And so that's something very interesting that's happening in the market. But I hope this is more an aberration and will kind of settle down. Yes, sir.
Yeah. So with respect to the return performance you had indicated, I just want to ascertain the recent changes in the taxation laws with respect to debt, treatment of debt and related expenditure in the hands of REIT had a significant impact on the price of REIT. Thereby, I think last 9 months, there's been a reduction in the, I would say there's a fall in the price. Probably, I do not know how much it contributed to, may have pulled down the performance of REIT, is what my inference was. I not got the exact figures, but the REITs lost price. They lost money actually. So.
It is possible, and I think part of the problem in the Indian structure is that these sort of changes keep coming in the middle. So and so people, if you invest for long term, you just cannot go to sleep, right? I mean, suddenly you wake up tomorrow, the government has changed the law. So I think these are all for an investor to consider REITs as a long-term investment option. I think you need to have stability in some of these basic things like taxes and so on. So, and I think maybe you're absolutely right. It could be driven by that. But I think in general in India, REITs have just marginally outperformed the bonds at various sub-periods. So it's not, and I think it's not large, and the GSECs give you zero risk, while technically REITs can go bust. I mean, even though there is an underlying collateral, I mean, there could be a lot of issues with that. So anyway, I think the REIT performance does not reflect the fact that it is an entirely new asset class that the country should cultivate, because it gives you a very good hedging for a lot of people. So that is,
yeah, Venki, before I would like to highlight that there are two questions which have been posted in the chat box.
okay, please.
Be pertaining to the previous slides or the thing. If you want, I can read it out.
Yeah,
now
can you
so that,
read it out? Yeah, can you read it out so that
yeah. Well, first question is from Kenmar 60067 @ Yahoo. So his question is: in the US, office real estate has been devastated by COVID. How has Indian office been affected by COVID? Has an office utilization returned to pre-COVID levels in India? Is this question.
So Kenmar, if you can hold on, I have a slide on how we compare with India and China, so US and China later on, where I address exactly that question.
I think second question is from Ashish Bansal. That is also related to China real estate. I think you will be dealing with it slightly later, I suppose. Okay, we can wait for you.
Sure. Okay, cool. All right, so the second mode of investment, third mode, is alternative investment funds. So essentially, these are, you can think of them as a variety of private funds, which could be a hedge fund or which could be a venture capital fund, whatever, that whole range of private fund options. The real estate focused funds come under the category 2 funds. So there are 3 categories in alternative investment fund lingo that the Indian securities regulator has put out. So on the one extreme is these large hedge fund kind of vehicles which invest in listed properties, listed securities. And the other extreme is you have these very small angel kind of investments, angel venture capital kind of investments. And in the middle is these focused investments, which are more like real estate is one example, infrastructure investments is another. So these are investments which have a collateral, a reasonably valuable collateral to go with, unlike a startup, which is completely betting on human capital. And of course, each category has different constraints. So in that respect, real estate focused funds have garnered a lot of capital. For example, over the last 10 years, they have almost a 90% year-on-year growth in terms of the funds that they have been able to raise. SEBI puts it out at the category level. So I'm not been able to figure out how much of it is real estate, how much of it is infrastructure and so on. But in general, that category has grown 90%, which shows that there is a lot of appetite for private capital to come in. So I was on a SEBI committee on AIF, and I got to know a little bit more from inside as to how much of it is private foreign capital versus private domestic capital. Unfortunately, a lot of AIF money is coming from foreign capital. And that is because there are, again, structural reasons why Indian domestic capital finds it very hard. Various reasons like taxes and so on. So I think this is another opportunity, because this is a great way for somebody to take the risk in real estate, at least at the early stage, for a reasonable return. And I think, and because we do not have enough capital available for development, I think the government needs to cultivate this option. And in order to, and not only make it appealing for foreign investors, but also to make it appealing to domestic investors in a big way, because there is a lot of domestic capital which otherwise is going on to gold. And as I was mentioning earlier, a lot of investment in the physical real estate, which is much higher ticket size compared to how much you need to invest in an alternative fund. So I think that's one thing. And of course, some of these funds have an egregious IRR expectations. So 20-25% is minimum for these funds because of the risk that they take. In fact, a lot of these funds are now becoming the substitute for developers for funding for land. See, previously it used to be that land cannot be, land could be funded by banks, then the banks stopped, then the non-banking finance companies stepped in, then they also stopped, and now it's all private equity and, the private players are coming in to fund the purchase of land. And land, as you know, is if you look at the value chain in the real estate in India, land is the place which has the highest risk. I mean, things can go wrong in the land, because once you have the land locked up, then the development is largely a waiting game, right? I mean, you should get the approvals if you're a reasonably good developer. And then after that, it is just a mechanical process of building and selling. But land can be, all sorts of risk can come out of land. And therefore, the expectation of 20-25% is, I would say, reasonable, given that in India, the risk is very high. But this is, again, there could be a lot of innovations in the financial side, especially for larger developers, to de-risk some of this and bring that IRR down. Of course, the latest fashion in this space is the fractional real estate. I think it's just literally at the kindergarten stage, the baby stage. So maybe it's still in the cradle and has not come out. And partly because it's completely in an unregulated space. So it's neither regulated by the securities regulator nor regulated by the real estate regulator. So so you don't have any recourse if something goes wrong. And so there are lots of open questions in fractional real estate. So just for people who don't understand what it is, it's basically it's like a REIT at a micro level, where people pool their money together in a special purpose vehicle, which will then go invest in literally like one shop or one floor of a building, or literally, one unit, depending on how much they are raising. And then whatever rent that comes goes back to the investors, just like the way REITs are. But unlike REITs, which are under SEBI's watchful eyes, so there are a lot of compliance norms, these fractional real estate business models are completely off the grid. You have to trust the player. And so the risk is on you in terms of doing the due diligence. Recently, SEBI came up with a working paper, or just to ask for public comment on taking this market and making it like a micro REIT. So they, just like the regular REIT structure, they want to create a micro REIT structure for this fractional real estate businesses and put all of them into that, and bring them under the SEBI's umbrella, which is a good thought. But again, the devil is in the details again in India. So there are a lot of loose ends that needs to be tied up to make that happen. Okay, the last one, which is completely the open sort of investment, is the foreign direct investment. So which is where, let's say, a large sovereign fund like ADIA or GIC can come in a big way, put money into a special purpose vehicle, and then directly enter into a joint venture with a developer and build. And so this is, these are for larger players, and typically the exits are only through developer buyouts, or in some cases through REITs. So like example is Blackstone. So they came in as FDI, and then now they're exiting through REITs. Okay. All right. Any questions up till this point? Before we move on to the bad, because we are on time, right? So we are at 8:45. So
yeah, couple of minutes more for you to step out for that meeting. Yeah. All right.
Yeah, actually, that's true. Couple of minutes. So in terms of the land markets, the bad part of it, I'm going to just list it out. Some of them are really bad, but I just put it under the bad part. The biggest problem we have is on a weak land markets. So which means we have ranging from poor land records to inaccurate land titles, lack of title insurance. And then, of course, there's a transaction price opaqueness. We don't know exactly what is the real price that people transacted. So there's a whole variety of issues related to land markets. And here is one area where India differentiates from China in a big way. So as you know, in China, the land is owned by the state, and they provide through the state agencies, the land is provided for development. So which means any upside in the land pricing is captured by the state. And therefore, they have the money that they have raised to invest in the infrastructure to develop the place. But in India, the land markets are captured by private sector. So which means if at all there is a huge increase in land prices because suddenly a factory is going to come or some rumor goes on, so all the surplus in the land markets are captured by private agencies. So which means the government doesn't have any money at the end of the day. So if they have to develop infrastructure in that place, they have to put their own money. So the private guys capture the land appreciation, and then on top of it, they also build and make money out of the development, while the government is purely acting as a cost center, to be able to develop. And so this is a bad model. And in fact, the only way it's sustainable is if government recovers some money back through land value captures, through taxes and things like that. But in India, that's the weak point. We are not very good at it. So this is one of the reasons why China could develop rapidly, because the infrastructure cost is partly borne by the increase in land values, while in India, governments are handicapped by that. So of course, the poor infra, we have also a low floor space index compared to most of the other parts of the world. So what this means is that for a given area of land, you do have, you can construct only smaller amounts. Like you can only build the developmental land or developable land is a smaller part of the actual land. So which is obviously a huge handicap, right? If you can't build a huge amount of vertical space, and it's only in some pockets you can do it. And I think that has also resulted in a lower supply or a much more inefficient supply. Most of legal costs are very high, taxes are high. By some estimate, about 30 to 35% of a project's cost in a real estate, residential real estate project is taxes. So that's 1/3 of the cost. So that's clearly a significant number. The cost of capital also is very high. There is no bank funding for land, as I mentioned to you earlier. And also, unfortunately, we do not have a very active securitization market. So which means that there is also a problem of the banks not being able to churn their capital. So they have to keep it in their balance sheet. So hedging options are not there. Price hedging for developers, interest rate hedging for banks, they're all, we do not have enough robust instruments for developers or banks to use them a lot. So which means most of them are sensitive to these risks, and therefore they price it in. And that's the bad part, in the sense, for example, a developer knows that in the 3 years cycle of building, construction might go up by 10-15%. Therefore, they don't have a very good view of what the actual hedging cost is. So they take the upper bound, and therefore they price it into the project, which I think is an inefficient way. I mean, because the market should give you what the pricing for hedging is, and so on. There is anemic rental market, as we all know. So which means the rental yields are very low, especially in the residential market, which again handicaps a lot of developers from creating rental housing and then exiting through REITs. And then, of course, one of my biggest bane against the real estate sector is they look at project-wise profitability as opposed to a portfolio profitability. So in other words, unlike, for example, somebody selling cars, they're not going to make money in every car. They can probably give a discount up front, get the buzz, get the demand going, and then capture it at the later end. But in real estate, that doesn't happen. So every project has to be profitable and has to hit certain numbers for the developers. And that actually results in many of them holding on to inventory, even at a significant carrying cost. And which is, again, seems not the right thing to do. I think the last part, which is the ugly part, which I think is the political economy of land markets. So in my view, land plays a very important role in financing elections. So because land markets are opaque and there's easy way to move money inside the market, practically they store money between election cycles. And I think that's a big problem, right? Because the reason it's a big problem is because nobody wants to clean the land markets. Because the moment you clean all of the land markets, you cannot do many of the things that which is universally across all political parties. So which means that nobody wants to change. So that's why a lot of things in the land markets remain ineffective at every state level, and no party has incentives to change it. In some costs, some estimates are about 5% of the project cost in larger urban developments, which are bigger in size. So, I mean, and these corruption costs could be in getting licensing, getting the land, getting the approvals, and of course, some of the landowner themselves could be politically motivated, so they may jack up the price. So there's so many other things that are, I would say bad, but this I think is a fundamental structural problem which will be very hard to remove in India unless you clean out the campaign financing part. So maybe I've got 10 more minutes. I'm just thinking, maybe can you give me a minute? I'll just tell them that I may be 10 minutes, 15 minutes late.
Yeah, please. Sure.
Yeah. All right. So I just WhatsApp. Okay. So if you have to enter the Indian market, I'm assuming more from a foreign investor, but of course, if people are here, they can also do this. As an investor, whether you're an individual or corporate, you have to worry about who you're dealing with, whether it's a developer or fund manager. You have to do the proper due diligence. In most cases, the landowner rights, you have to figure it out, because many of the developments would be also having the landowner in the agreement because of the joint development and so on. So, which means the landowner rights, you need to understand what it is. And similarly, you have to be very careful about what sort of credible exits you have in your option, in your investment vehicle. Some of them, like for example, investments made in 2007-8 vintage, they have not exited still, So those sorts of, so there are very long exits because you just don't have the, wherever you depend on the developer to help you exit, that could be a problem. So you have to figure out which options give you good exits. So some of the things like REITs, you have a market-based exit. So which means you can go sell your REIT in the stock exchange, but there could be other ones which depend a lot on other things. I would say generally prefer debt over equity for investors in Indian markets, because equity is a long game and there are too many risks for to be properly priced upfront. So either people overprice it so that they have an IRR of 25-30% that deters good developers. So only the people who are, I would say, shady developers take these 25-30% sort of IRRs and then end up getting stuck, because then their project feasibility or profitability gets taken out when even a small shock happens. So debt is a preferred structure, and now that we have some protection for debt, that could be still a better option. Of course, the moment you have an unlisted space, you need a lot more disclosure, demand disclosure and compliance, adherence to compliance. Because a lot of the fractional real estate is a classic example, because there's absolutely very little disclosure and also very little compliance. So because they are completely unregulated, so there's no compliance per se. So you are taking a lot of risk in such a vehicle. Or for corporates, if you are moving in to set up a real estate, set up an office or any sort of an entity here, I mean, I think most people follow brokers. I mean, reputed brokers as intermediaries. The rent structures in your tenancy agreements, I think has to be properly vetted. And of course, the break-in clauses, like things like COVID can happen, where business might completely suffer, in which case, what do you do? I mean, are there clauses which help you, get out of it? So these are some of just a thought. Maybe this I can just quickly just show you what it is. I mean, general in India, we have a few real estate cycles. I'm only capturing the half life of the cycle, which means from the bottom to the top. So we had 92 to 95 as a huge liberalization-based boost. And now we are from 2020 post-COVID, we are seeing a huge, another sort of a cycle that is going on in real estate. In terms of headwinds, and this is where I was going to talk about that question earlier on what happened to work from home. The West is feeling the heat. I was in New York. I mean, I was shocked to see that 25% vacancy in New York buildings. And there's a big expectation that many of the renewals will not happen next year, leading to at least a few developer defaults. The difference between India and the West here is that India has had a steady vacancy of about 15 to 20% in the commercial space. So most of that vacancy is already priced in. So COVID has not increased it. While in the West, the vacancies were more in single digits and has gone up to 20-25%. So they did not price it in. So that's probably the reason why many of the developers are struggling in cash flows. While in India, because the COVID has not really changed that number, the developers are in a slightly better position. In terms of the other factors, we have obviously lesser inventory and oversupply now, so that definitely the default risk has come down. We have much lesser chance of a housing price crash compared to the US, for example. I mean, US, the link between housing prices and the overreach of the developers' capital base is very, very strong. In India, that is not there. So which means the housing prices don't crash as much. And even if they do crash, it doesn't lead to a lot of developer defaults because there's a lot of protection that is built in. And many of the things that we have are much bigger problems in China and the US. China is purely not because of regulatory thing, it's just because they've oversupplied. So the domestic market has sort of slowed down a bit. And so therefore, a lot of supply needs to be taken out, and most of these builders are carrying that cost in their balance sheet, and that's what is driving them down. Because when they have to refinance that debt, they just can't afford it because the new debt is going to be priced much higher than the old debt, and many of them don't have the cash flows to meet it. So that's where the problem is in China. In the US, it's the vacancy issue in the commercial space, followed by also, I think the median house prices in the US are coming down. So my expectation is 2024-25 is going to be bad for the US real estate market. More so in 25. I think I've heard somewhere that 25 is when a lot of the renewals or debt, refinancing of debt is going to happen. And so that might cause a trigger of defaults. So that's what it is. We also have a lesser chances of systemic risk because the loan to value ratio, we have much lower loan to value ratio. And as I mentioned earlier, our securitization is also much lower. So because of which, the risk is sort of embedded in one entity and not transferred to a lot of other entities through these securitized products. So that's another thing. Some of the future things that we need to worry about in the market is one is the environmental thing. I mean, we have an ambitious target of net zero by 2050, which is what the CREDAI, which is the Association of Builders, have decided. I mean, it's incredibly difficult to do this, and it needs a huge amount of capital, not just the capital that I talked about getting new houses, but We are talking about even retrofitting the older buildings to make them sustainable and reduce the carbon emissions. That's a huge capital investment. We see already some benefits of doing that, because you have about 7 to 14% that people have estimated as green premium in the rentals, at least in the commercial space. So that means there is a potential. In fact, we are working with a startup which is in creating this retrofitting business model, where they will come in, take over the building and hold the lease for 10 years. And while in that process, they will do the retrofitting, convert them to gold or platinum standards, and then they take the rental appreciation. So they will do the capex, and in return they will get the higher rentals. And it looks like a great business model. And so there are new people that are coming in to do this. The other thing on land is the development as I said, land is a huge component of development cost. I think governments have to start thinking in a creative way. And recently, Telangana did a fantastic job of putting a lot of government land and made the developers bid for them. And they were able to extract the surplus. So this is what Telangana did, is very similar to what China does. So the land surplus that I was talking about gets captured by the state. And therefore, they can use that money to put it into development of infrastructure. I think a lot of other states should do this to be able to make use of some of the land that is lying vacant. And of course, some of the policies like FSI needs to be changed. I just wanted to mention one thing on the agricultural land. So if we take all the land that we need for urbanization, it would constitute less than 1% of the agricultural land we have available. Okay. So, which is not to say that we need to take away farmland, but I think we need to increase the farm productivity so that we don't need as much land for the same amount of production. So in a way, this has to be a sort of a longer sort of a play for the government to be able to not have so much land for agriculture, which is only contributing less than 20% GDP, while the urban market, the urban centers contributed more than 50% of the GDP. So, you have a huge skewed distribution of land, in the sense that more land is available for creating lesser productivity. And I think that's whole thing has to be changed in order to make land more active. And it also gives you more creative ways to create new cities and so on. And also the domestic institutional capital has to come in to replace the foreign capital. I think we can't just completely rely on foreign capital to drive the real estate sector. And so we need a lot of domestic capital, especially money coming from mutual funds and so on, that should go into some of these development projects. So that's all I have.
Yeah.
So I'm
I
happy
have
to few
questions are there. If you
please.
Yeah. Vineet would like to know what do you mean by high legal costs?
See, the legal costs, there are two kinds of cost in the legal setup. One is, like, for example, if an investor gets into a contractual problem, it's very hard to solve through the courts. So which means, hard to solve is not, what I mean to say is that it takes time and it takes money. And so what happens is that any investor who understands this will price it upfront. So part of the 20-25% IRR that they're expecting has maybe 2-3% as legal cost that goes towards that, So they know that out of 10 investments, maybe 3 will go legal, And so therefore, legal cost from an investor, it's like that. From a developer, it's even bigger, right? Because the developer puts money up front and then finds there is a title issue. Then they'll have to go. I sit on the board of a developer and they're fighting a 10-year case. Still the case is going on, and the money is stuck and the land is stuck. So they missed that boat, in terms of
Yeah.
trying to finish and monetize that land. So they're stuck with both, and they're not able to get out of it. The arbitration keeps going on and so on. So in a way, all of these things are a problem with the Indian system, which gets priced in, and that is part of the reason why the costs are high.
Got it. Thank you.
CA Sudhir would like to know, how do you see things developing in future, and what further steps, corrective action that are required to be taken for real estate?
That's a long, I think that I need
Yeah,
another
okay.
answer.
That's what, okay, I get it.
I mean, part of the problem that I mentioned, you need to correct that. So that's what it is. So you need to reduce some of the cost associated with that.
Yeah, and Valuer case, Venkatakrishnan would like to know, what is the impact of lending by financial institutions to the unorganized properties, for unorganized properties without appropriate approvals? Any, I mean, you have any
any lending or investing is a risk return trade-off, right? So if you are doing it to an unorganized property and without proper papers or proper documentation or whatever it is, I mean, you are taking risk. So the question is, you have to first understand whether you have the appetite to kind of take on such kind of risk.
Okay. I think, I don't know whether we had addressed Ashish Bansal's question on, does China's real estate market slow down? Will it have an impact on Indian real estate market growth? I think that was his question earlier.
The link between China and India is a slightly weak link. I mean, I think the Indian, the only direct link would be through foreign investors, right? People who move money from Chinese market to here.
Yeah.
But my guess is that the Chinese market already had slowed down quite a bit. So I think I would say the bigger link was not directly through the real estate market, but more in terms of China having a sort of a mini economic implosion, which in turn might cause opportunities for Indian companies to step up, which is kind of the China One strategy, but in a slightly bigger scale. And therefore, the ancillary effects on the real estate industry. So which means if more companies are coming here instead of going to China, therefore there'll be more demand for real estate and so on. So I don't think the Chinese investor capital is going to be a big play here.
Okay. Probably more of sentiment.
More of the real economy, not the real estate part. Yeah.
Okay. There's a question from Meghana. She wants to know about this SC Land Act. I don't know what. Can you specify? She mentioned SC Land Act, or does she mean SEZ? Meghana, can you please clarify? I'm not able to understand your question. She is still here?
Yes, sir.
Yes,
hi, sir. So I just wanted to understand about this SC/ST Land Act, which is by the government. So I'm not sure if this is the right platform to ask this question, but I just wanted to know more about this particular act.
I do not know too much about it. I only know a small thing. I mean, let me tell you whatever little I know. See, basically, SC/ST land it's like the reserve land in the US, right? For reservation lands, right? So which means basically who can buy and who can sell, and the transaction itself is highly regulated. So which means if you have an SC/ST tagged land, which means somebody who owns it is in that category, then there are only certain kinds of purposes in which it can be used, and it's highly regulated, right? Because they obviously want to protect the buyer, protect the seller of the land. But unfortunately, what's happened in the market is that many people don't touch it. The moment you have an SC/ST tag, they find it very hard to transact because they know that maybe down the road some problem might arise. So even though the act was meant to help land which belongs to the category owners to be able to sell easily. It has actually backfired in a different way. It has made everybody not very wary of transacting. So I think my guess is it's a little bit of tweak they need to do to make it achieve its objectives. So this is all I know a little bit. Beyond that, I don't know.
No problem, sir. Thank you so much. That does give me some kind of clarity on this.
Yeah.
Thank you.
Yeah.